Best ever listeners, welcome to the Best Ever CRE podcast. I'm your host, Joe Cornwell. And before we get into today's episode, I want to remind you all that we have the Best Ever Conference coming up March 3rd through 5th, Salt Lake City. And right now we have a 25% off if you use the keyword podcast25, that's all lowercase, besteverconference.com, podcast25, all lowercase. You can get 25% off your tickets today. And I hope to see you all in March at the Best Ever Conference. Today, we are joined by Ral West, first time on the show. She owns the company Ral West, Living the Dream, and she has invested in over 6,000 units of multifamily. She's done triple net. She has done vacation rentals. She's done just about everything when it comes to business and real estate. So, Ral, welcome, and thank you for joining us today.
Thanks, Joe. It's a pleasure to be here.
Well, we appreciate your time and looking forward to hearing your story. So why don't you start with your background, tell us a little bit more about you and how you got into real estate.
Okay. Well, real quick, I was born and raised in Seattle, Washington, and in the early 80s, I moved to Alaska and started off working in a tour company. And about a year later, I moved to Anchorage, Alaska, and started another business there, my own business, and also joined my husband in a business that he started. We scaled that business to 8 digits in annual revenue and sold it to Alaska Airlines in 2008. Along the way, we started investing in real estate. First of all, it was, residential for us, but then we started investing in commercial property. We had our business housed in a piece of commercial property that we owned. Then we started investing in single family. And we were the landlords and did the, tenants, toilets, and termites. And then it was like, okay, that's getting a bit, too much work. And in 2021, we found out about multifamily syndications, and we started learning about how to do that by joining the Brad Sumrock Apartment Investment Mastery Group and became a member of his Millionaire Multifamily Mastermind. And that was a fast track education in how to do multifamily syndications. So that's when we started investing in the multifamily. And now, as you said, we are invested in over 6,000 units across 5 states in the U.S. And that's been quite a ride because we started investing in 2021, a year before everything kind of got real hard.
Yeah.
So, interest rates climbed and everybody else knows that story, so I don't need to go further on that. But we have vacation rentals in Maui. We have a triple net lease in Alaska. We've got a couple of 10-plexes here in Sitka, Alaska, where we live now. And, just real estate has been very, very good for us over the last 30 years.
Yeah. Well,
it's solid.
Yeah, that's been an incredible journey. And as I mentioned, you've done so many different things in your background. I guess one question that initially comes to mind is what coincided with that mindset shift from doing the singles and the vacation rentals? And it sounds like a lot of stuff you were, really actively operating and managing, getting into a larger scale investment that allows you to take less of the active role.
Yeah. Well, I think that is hand in glove with my starting this business, Ral West, Living the Dream, which is, be able to operate your businesses without having it own your life. We love to travel. We have a home in Maui and our home in Alaska. We have a yacht. We want the freedom to be able to do what we want to do. Now, if you're the landlord, you don't really have that freedom. You've got it unless you have a good property manager. And we thought, well, we need to scale this so that we can hire really professional property management. And that's when we learned about the syndications where we could invest our money and get good returns without having the headaches of, really being the hands-on management. So that was why that was very attractive to us. And the tax advantages of investing in multifamily, we got wonderful bonus depreciation that we're still benefiting from. Being able to get your tax bill down to zero is a pretty nice benefit.
Yeah. Well, and look, that obviously sounds great. I'm sure anyone listening to this is like, well, yeah, of course, if I could, invest in real estate and be mostly passive and travel and not have it interfere with my day-to-day life as much as it maybe does for a lot of us. What are some strategic things that you have implemented that has allowed you to be more passive in your investments?
Well, I think that first of all, you have to have the systems in your own businesses so that you can take care of all of the financial needs and monitor all of your investments with reporting and data and be able to track what's going on. Have a team that you can call upon to do things as needed. So I think that's the main key to it is you've got to find that leverage and use it so that you're not as tied down. But, still any kind of investment requires some attention. We can't be totally free of it. With the internet being available pretty much everywhere, it was a little tough when we were in Antarctica, but otherwise we were able to keep tabs on what's going on.
So what are some of the systems you utilize personally?
Well, we have reports, financial reports for sure. And when we're talking about like our own 10plexes, we have systems set up so that we have a local property manager in Sitka, and we've outlined exactly what to do to rent a unit, what's the check-in procedure. Here's the checklist, take pictures and check everything off to make sure that the tenant says, yes, this is all in good condition. And then also procedures for the exit, again, a checklist to make sure that we've noticed anything where there was damage or something that, missing, and then we can take that against their security deposit. So we have manuals, written manuals for our property manager to follow, and that helps a lot because we don't have to be there to answer all of her questions day in, day out because she's got the manuals to guide her.
No, that makes sense. Now, is this an employee or is this a third-party company?
Contract.
Okay.
Contract, yeah.
Okay, but they're not operating like a larger management firm. They're working directly under you.
Yes, because we just have the 20 units here in Sitka, so it's a part-time job for her. Works out really well, and we're at 100% occupancy. So that's really nice.
Yeah, no, that's a great point about building your own systems. I have a new business partner that we're working on a lot of mergers with our businesses, and that's one of the things that we both kind of harped on within our current businesses is like, hey, there's so many things here that fall through the cracks, both on the investment real estate side, and we operate construction companies, and it's like if you don't have those systems in place and have very detailed instructions for anyone to pick up and run with, you're going to constantly have the same conversations over and over and over, or you're going to miss a lot of things, as you mentioned.
Right. Yeah. And so you have to have systems like, okay, what date do you notify the tenant that their lease is terminating, so that you give them the 60-day notice, and what the rent is increasing or not, and so forth. So all of these things have to be calendared and laid out so that they're taken care of. And we have procedures for what happens when somebody wants to terminate their lease early. What do you do? What's the administrative process for that? How to handle maintenance? All of that. Think about it in advance as much as possible. And if there's something that you haven't thought of in advance, then that becomes part of the system once you encounter it and you document it, put it in the manual.
Oh, that's great. And now, my assumption on some of these larger projects that you're investing in as an LP or a GP, they do have, full service management companies in place. Is that correct?
Right. So we don't have to create the reports or the manuals. They've got them, but we do monitor what the performance is, and we keep tabs on how they're doing.
Yeah.
Of course, in this environment, and oftentimes, unfortunately, now we're having to put money in, for capital calls or making a GP loan, because a lot of the properties are struggling with the interest rates and increased property taxes and insurance, especially in like Florida and Texas. They're getting
Yeah. So how do you go about finding the right fit when it comes to property management? Like what specifically are you doing to vet them? And have you had instances where you've had to, let managers go and implement a new one?
Right. Well, we're not the actual lead asset manager on most of these deals, but we have been involved in situations where the property management company had to be replaced. They were not performing. They were not meeting the targets. They were not doing what needed to be done to keep this property going and to make sure that it was beneficial for the owners. I think it's terribly important. I keep harping on this, is that there has to be alignment between the property management team and the asset management team. They have to all be going for the same goal. And when they're not, which has happened from time to time, then there's discord. And, the results are disappointing, and the asset managers are going, hey, wait a minute, we're not hitting our targets. We don't have the occupancy, we don't have the revenue, the NOI is not where it needs to be. And if the property management company can't meet those criteria, they need to be replaced. They're given a fair warning, but then they need to be replaced. And it's been a struggle. Lots of property management companies are very, very good, but there are some that are just not doing the job, or in some cases, unfortunately, they're like not being responsible for the money. and they're kind of taking more than their fair share, and it's ended up hurting a few of our properties. So you have to be very diligent and do the due diligence on the property management company as well as, on the property that you're buying, and then stay on top of them. You have to be very focused on what they're doing and keep guiding them.
Yeah, and one thing I've noticed, I mean, and this probably these principles apply to almost any business, right? But it's property management is a low margin, high volume business. And so every property manager I know personally, they have the goal to scale, almost all of them. I mean, there's a few that like may have a very sweet spot they want to operate in, and that's where they keep their units under management. But more often than not, property management companies' goals are to continue scaling, which obviously drives revenue and allows them to have more infrastructure and all of these other benefits. The issue I've seen is that while they're scaling, they have this constant struggle of workload and operational ability to actually take that workload, right? And there's always this lag. So they're trying to get new business. They're trying to, operate the existing business. And most property managers that I've personally worked with are seen struggle mightily in that growing phase. So, I don't know what the answer to that is. Those are just kind of observations. But this is, in my opinion, why most property management companies get a really bad rap, because it's a difficult business and they're just not managing it well. I mean, it seems like you've seen some of those in some of the markets you're in.
Yeah, that's true. And I'll go back to systems. If the property management company developed the systems better and got their team aligned with the company's goals, like the goals to scale, I think that they would be a lot more successful. But oftentimes they're not doing that. And that's where you have the problem. That's where you've got the management or the owners of the property management company want to grow, but the people who are on the front line in the rental office are saying, we can't do this and we can't do that. But they need to have their parameters laid out for them, their policies and procedures, and they need to have some incentive to meet those targets. And sometimes the incentives that are being given are not appropriate. For example, I've seen companies where they'll grant a dollar bonus for every renewal. And then my question is, but what kind of renewal? And are we doing the right kind of, get $75 or $100 or whatever for every renewal? And it's a 6-month renewal with somebody that really shouldn't be even renting there because they don't have the credit score and so forth. So, you're rewarding something that's not really beneficial to the property management company or the owners. So you really have to be careful about spelling out what your criteria is for what a good job looks like. And I think if the property management companies did that more, then they would have an easier time with that struggle. But yes, you're right. There's always going to be that, a little bit of, how much can we actually handle? We want to grow, but we've got to get the infrastructure in place with our team and all that to be able to grow. And you can't grow faster than you've got the team, and you can't put the team in place faster than you've got the business to keep them busy. So, it's a little bit of, a juggling
chicken and egg situation. Yeah. And again, obviously that issue affects almost every business and every type of business. But I think it seems it's an obvious issue with property management, something I've noticed repetitively. Okay, so you've invested in so many different types of real estate, as you mentioned, over the last 30 years. Seeing these last few market cycles, seeing the market cycle that most people agree we're heading into kind of a new market cycle. We're on the precipice of that.
Hope so.
What? Yeah, right. I mean, and that's the reoccurring theme I hear in these conversations. So what are you most excited about looking at 2025 and beyond?
Well, I hope that 2025 is going to be a year where things, stabilize and lay the groundwork for growth in value for all of these properties. The NOIs have to be able to grow so that the value can grow and meet the target price point. When all of these pro formas were done, when the deals were purchased, they were anticipating certain numbers that have not been able to be met. So if we can see in 2025 a stabilization of that so that these properties can hold on until the market really turns around, whether that's in late 25, 26, some people are saying 27, it's all, who's got the best crystal ball. And of course, none of us had a very good crystal ball back in early 22. So, but I am optimistic. I do believe that it is a cycle and that it will turn. The question really is when. Yeah.
And what asset type are you most interested in?
Well, I think we continue to be interested in multifamily, and we also like triple net leases. So, those are good. Yeah.
Yeah, it's also triple net's not something that I personally discuss a lot on the show, and I know some of our other hosts like Ash Patel, they focus more on commercial real estate, so they probably cover triple net more than I do. But my question to you is, what are your general thoughts on triple net? What do you like about it? What are some of the cons about that type of asset?
Well, usually a triple net lease is one that's secured by a real bankable tenant. Like the one we have is a Sherwin-Williams store. So, they've been around forever and they've got thousands and thousands of stores. So you sign long-term leases, you have escalation clauses in the leases right up front for, increasing the rent at certain times. And they're, again, long-term leases. So they're bankable. And then the triple net implies that they take care of most of the maintenance and that they pay the property taxes and the insurance and all of that. So it's very little management activity on the part of the owner. And that's the advantage of them. So they're easy, good, solid tenants. They pay their rent on time and all of that. So there's a lot to be said for them. But you do have to make sure that the tenant that you're buying a triple net lease for is a real solid, bankable tenant. You don't want one that's going to, fold its doors in a couple of years down the road. So you need to go on their track record.
And I assume somebody like Sherwin-Williams, would give a corporate guarantee. So it's not just that location with that tenant with that store. You also have the higher level security of the corporation behind it.
Yeah. Yeah. So it's a real solid investment. So we've been in it for almost 10 years, about 8 years, I guess.
Okay.
Yeah.
Yeah. And, and really the simplest way I look at triple net is like, that's just pure cash flow, right? I mean, you almost have fixed expenses and then you almost have fixed income, within reason, assuming everything goes to plan. And you kind of know day one, this is what I'm going to net over this term.
Yeah.
Unless something crazy happens. But there's a lot of security in that.
There's been a small handful of maintenance issues that we've had to deal with, but it's usually handled with a phone call and the manager of the store, get somebody out there to fix a leak in the roof or something like that. And so it's pretty easy. So it's not a real time consuming project to manage these, which is nice.
Yeah.
Passive
that triple net is the closest thing to passive income I think we can, outside of being a completely passive investor, of course.
Yeah, an LP. Yeah.
Sure,
right.
sure. So is that something you are, you're still bullish on that, looking for opportunities in the triple net space that makes sense?
Sure. Yeah. And we're not looking at just Alaska. I mean, we did happen to buy this one in Alaska, which is our home, but you can buy triple net leases anywhere in the country. So you need to look at the market and do your due diligence on not only the company, but the market and make sure that this location is viable and all of that. But there's real estate still offers tremendous opportunity. So we're still very bullish on real estate. And yes, it's a struggling time right now in multifamily, but I do believe it's cyclical. So just a matter of, getting through the bottom, which I think we're at the bottom. We need to be able to ride it out until it starts turning up.
Yeah. Okay. So you've invested clearly in several markets now. Do you have any insights on markets that you are, again, most interested in thinking 2025 and beyond?
Dallas is still very, very promising. The numbers are very good in Dallas. The employment numbers, the population growth numbers. Again, it depends on the submarket that you're in, as there are submarkets in Dallas that have been challenging. So you have to do that due diligence and make sure you've got a team that really knows the local market. And it's difficult to swoop in from Alaska and say, okay, yeah, I can figure this out by just visiting for a couple of days. No, you really have to get people who are boots on the ground and know what's going on in those submarkets and look at the demographics and the economics of each submarket.
Yeah, no, that makes total sense. And I've been hearing about the upsides of investing in Texas and obviously the Dallas Fort Worth area for 10 plus years. Is there anything else that and again, you don't have to give a specific neighborhood or anything like that, but states or regions or other metros that you're interested in looking at going forward?
We've been watching the Carolinas for a while and Tennessee, Northwest Arkansas. We were pretty bullish on Florida, but with the hurricanes that they've had, that's a bit tougher now. The insurance is really, it's really hitting them hard there. We're in Arizona, but again, it depends on the market. Tucson, we're seeing a tougher time there right now. Phoenix seems to be a bit stronger. So, and it changes. It changes sometimes from month to month or a couple of times a year at least. So you just need to keep watching the statistics.
All right, so shifting gears a little bit here, you have something I read in your background. One of your greatest lessons is to plan your exit before you buy. What does that mean to you?
Well, I'll give you an example of one that we did very poorly.
Okay.
Many years ago, we were looking for real estate in Anchorage. We lived there at the time. And I found out about a motel and RV park. And I loved the property. It had a beautiful view. It had high traffic. Oh, this is great. And I'll take this motel and RV park and I'll convert it to multi-use, commercial, residential, and so forth. And I thought that was just a wonderful idea. Great piece of property. After being in it for a while and seeing that the motel and RV park were not hitting the numbers income-wise that we had seen in the financials, the history did not repeat itself in the future. And then we started doing the numbers on the conversion that was my pipe dream. And then the numbers didn't crunch on that either. So we ended up holding that property for way longer than we should have. I think ended up being like 17 years that we held it, and finally ended up selling it in 2019 and did not make any money on it at all. So that was my big lesson. It's like, okay, if I had actually done a better job of just, instead of like, ooh, this looks wonderful, let's do this, and it actually crunched the numbers before I bought, I would have been a lot better off. So big learning experience.
Yeah, let's talk about that deal a little bit. That's very interesting. Okay, so you bought this RV park in 2002 and you sold it in 2019, and you're saying the value over that 17-year period was approximately the same you paid for it?
It dropped.
Wow. How, like, walk us through that. Well, how does that happen?
Because of the revenue.
Okay. You weren't growing revenue over that whole period.
Well, the revenue grew some, but not enough, and it was an older property, so we poured tons of money into renovating and kept trying to turn this pig's ear, into a whatever that expression is. Mm-hmm. Silk purse. It never became a silk purse. It was still a pig's ear. And it looked a lot better, and we were very creative. We did some long-term rentals. We turned some of the units into like little studio apartments and then did long-term rentals. And so that was good because Anchorage is a very seasonal market. So we were full in the summer, but then the winter, which, is about 7 months, was just this big gaping hole.
Mm.
Another big mistake we made is that we bought it shortly after the big, 9/11 thing, and we didn't know that there were a number of big box hotel chains that were coming into Anchorage at about that time. And they started opening up in 2002, 2003. And it's like this little old property that was, built in the 60s could not compete with the Hampton Inns and the Marriott Springfield Suites and so on and so forth. So we had a tough time. But we did a valiant effort, tried many different ways to increase the revenue. Some years we got close to breaking even. We had a great team. We used all the systems and everything. But I think it was just an uphill climb given the type of property that it was. And the location was great. Again, if the numbers had crunched, because the residential and other commercial real estate market in Anchorage just wouldn't support the values that it would take to make a conversion to like a condo commercial property combination work. We couldn't get it. Couldn't make it crunch.
Okay.
So
in hindsight, having gone through that entire 17-year process, and I don't know how much time, you were spending on this every year or whatever, but
too much,
right? Not to make money, of course. But it's in hindsight, was there a point in time when you look back where if you could have just cut your losses and exited for whatever the damage might have been, knowing what you know now, would that have made sense at a certain point?
Yes. We definitely held on too long.
Okay.
We kept thinking, we know how to do this. We're going to make this work.
Next year's going to turn around, and you said that 17 times.
Yeah. Overly optimistic, and we could have done a lot better if we had taken an exit earlier.
Yeah. So well, thank you for sharing that. And one thing we like to do on the Best Ever podcast that we don't see a lot of other podcasts doing is sharing not only our wins, but obviously our losses and some of our lessons learned from that. We like to show all sides of real estate, the good, the bad, the ugly. And, your story is unique in the sense of we've had a lot of people come on here and willingly share some of the deals that went sideways, but the fact that you stuck with it for so long and still, you know what I mean? And because the old like cliche is that if you hold on to real estate long enough, you can't lose. You know, I've said it, I've heard everybody say it, you know, and it's interesting how you can show all of these things. And as you say them, they make perfect sense to me. I'm visualizing this and visualizing everything that happened that you had to, you know, try to navigate and overcome. And still after 17 years, you weren't able to increase the value in a meaningful way. So yeah, I think that's a great lesson for people to take.
Yeah. And hopefully one I will never have to relearn.
Right. Yeah. That's the key, right? If we never make the same mistake twice, we're all going to be doing great.
Yeah. But I have to say, in our 30 years of investing in real estate, that was the worst case. And just about everything else, we've made money. So
great. Well, why don't we do this? So normally I have an actual segment I call Bad Deal, Good Deal. You already gave us a bad deal, and that was a great lesson. So why don't we wrap this up on a good note? Give us a good deal that you really enjoyed.
Okay. Well, our vacation rentals in Hawaii have been fabulous. We started buying them in the mid 1990s, and we're paying, you know, $50,000 to $75,000 per unit.
That's crazy to think about. Yeah.
Yeah, and our recent sales have been close to $700,000.
Yeah.
So we like those a lot.
Yeah.
And the cash flow is good, you know, as a vacation rental too. COVID, of course, was a hard time, but overall, they've been lovely properties. And so we've been selling them because the market's been really, really hot there. But we're still holding on to a few. We had 20 at one point.
And that's the prime example of if you hold on to real estate long enough, you're going to make a lot of money, right? You know, great location, great market. You know, like you said, 10xing your investment. So yeah, that's a great one to end it on. So just a couple final questions for you as we wrap up. Again, I mentioned we're recording this at the end of 2024. We're looking at 2025. What is some actionable advice you could give our best ever listeners?
I think that if you're going to be investing in a syndication, for example, you need to pick your team very, very carefully. You need to really know who you're investing with, who the lead general partners are, and you need to vet them as much as you vet the property. Get the references, find out what deals they've been in, what the returns have been, talk to people who've invested with them, and try to get the good, bad, and the ugly on each of the general partners before you do anything like that. And the other thing would be just in general, I said this before, is just be very careful about your market. You don't just look at the broad market on a geographical basis. You look at the submarkets. And even within a submarket, you could be on a bad street, you know, or you could have a location that's right next door to a dump or something that's just not going to bode well for a good outcome for you. So just be very, very careful going in. And as we said, plan your exit strategy before you get into it.
Yeah. No, that's a great philosophy.
Everything's a risk. So don't risk more than you can afford to lose. You want to be able to sleep at night. So if you're risking the whole farm on this, maybe that's not such a good idea. Maybe, risk only what you can feel comfortable if it all went bad.
No, it's all great advice. And, you have the wisdom and it makes sense of your philosophy for sure.
Yeah. But again, real estate will continue to be solid. It will. It always has been and it always will. And there will be cycles. We're in one now.
Yeah. All right. Couldn't agree more. Okay. So, Ral, final question for you is where can our best ever listeners connect with you and find out more about your business?
Well, I would love it if they would go to my website, www.ralwest.com. That's RALWEST.com. I have a free webinar that talks about what I teach in my course, which is teaching entrepreneurs how to work on their business instead of in it, be the owner and not the operator. And I'm heavily into systems, leverage, building your team, kind of the things that we've been talking about in regard to property management. That's all in the course. So yeah, look me up, ralwest.com.
We will link to that in our show notes. And again, thank you so much for your time and sharing your story with us.
Thank you, Joe. Appreciate being on.
Best ever listeners, if you enjoyed today's show, be sure to leave us a 5-star review and share this with someone who could gain value from it. Make sure you're following and subscribe to the podcast so you don't miss anything. Thank you for listening. Have a best ever day. And before you go, reminder, Best Ever Conference is this March 3rd through 5th, Salt Lake City. You can order your tickets today with 25% off using the keyword podcast25, all lowercase. That's podcast25, lowercase, at besteverconference.com. And I will see you all there in March at Best Ever Conference.